All right, and welcome to the Uncommon Sense Podcast. I am your host, Blake. Today I've got an old buddy, one of the craziest DNs I ever played with. Scared the crap out of me every time we went up against him, but now he is a financial security advisor at his own investment firm. Is that what it is?
Yeah, well, I mean, I work with a lot of different companies, but I'm incorporated. I have my own practice going on now.
Well, that's boss style. Okay, Mr. William Miller, how you doing, buds?
I'm very good, man. It's been a while. I hope you and the family have been doing well too.
Oh, we're real good. We're good, man. As best as anybody can be, in these situations, in these days, and crazy COVIDs, and we're hoping the world's just going to open back up again. But something that's come out of this, everyone being at home and on their computers and stuff, obviously is I think a lot of people have started paying attention to the market a lot more, trying to find ulterior ways of making money or trying to stretch their investments, stretch their savings a little bit farther because none of us know when exactly we're going to get back into normal life. But I've been reading all this stuff about this GameStop. I'm a gamer myself, so just seeing this stock like explode, whatever it is, 3,200% or whatever it is, and then delving or whatever the number is, and then delving into it and understanding the whole movement that's behind it. It's crazy. And now it's got hedge fund managers losing their jobs. The guys are talking about they're losing billions, and I wanted to talk to someone who I figured would know something a little bit about it, or talk about the intricacies about how interesting this whole anomaly is. And I was like, you know what? I remember Will's doing something in that financial sector. I bet he's got some knowledge about this whole thing. So yeah, man. It just what's going on with this whole thing? How is this whole anomaly taking place here?
I guess the first thing I would say is thank you, Blake, for asking me to come and participate in this. I mean, no matter what, these are things that I find extremely interesting, and I'm reading about this type of stuff on a daily basis. And, I've made my own posts on the subject because I thought it was just really, I think the fact that it was GameStop and not some other type of company that maybe people didn't know so well, that I think that probably helped the profile. But I was just looking on my phone today because I hadn't checked in the last couple hours because, there's one thing you mentioned earlier that I would say is very important that I will come back to is you said people are trying to find ways to make money. They're at home and they're looking at different options. And I personally think that this is one of the big factors that's led to this. But GameStop shares right now currently on my app are $114 a share, which is still a huge increase over the $2 or $4 it was.
$2.83, yeah.
It spiked, well over $400 a share at one point. So just today, it's come down almost 50%. So I think what's happening is that now you're seeing the reality kind of hit. So I don't know, man. If I could overview it in a very simple way, it seems that, this Wall Street Bets Reddit group, which I'm not a part of, it was kind of like a new thing to me. I'm not big on Reddit personally. I'm not like the most tech savvy social media type person. I've been trying to get better at it. Somebody on this forum, people are exchanging investment information and they're communicating and they're trying to work together, and it's a community. And somebody, I guess, did some research and found out, oh, hey, there's these, Wall Street firms that are shorting GameStop big time. And just to explain really quickly, because maybe some people don't know what shorting is. And
for sure.
I don't personally, do that in my business. I'm not doing options trading and stuff like that. It's one day down the road, but it's definitely much more risky and much more complex. But when you're shorting a stock, you're essentially betting that company's going to fail, right? So if a stock is trading at $20 and then it goes down to $2, well, those institutions or people holding the short positions are going to profit from that, right? Because they're buying the rights to profit from the decrease in value. So these people got together and they said, you know what? We're going to squeeze these short positions out. We're going to, start a trend, and we're going to get investment money coming into GameStop, because now if a whole bunch of people invest in that company and the stock price is going up, well, those short positions, they say it gets squeezed out because they're losing money, right? They're betting that the stock price goes down. If the stock price goes up, they're going to have to buy more shares to cover those losses. So, I mean, a lot of the analysts are saying like this is what happened, right? Because you kind of have all of these different things going on at the same time, where you had these short positions. Now you've got all these new investors coming and bringing money into the stock, which is increasing the price. Now those short sellers, they have to buy more shares to cover their shorts. So they're also buying, which is also increasing the price. So, I mean, I guess theoretically, this seems to be what happened. But then there's other layers to it where, you know, a couple investment firms, Robinhood, one in the States, where it's kind of like an online discount broker. You can go and buy shares of a company at no cost, no trading costs and stuff. So it's been, they call it Robinhood because they're saying, you know, we're trying to democratize finance. You know, they have this whole mission around it. But they essentially, you know, froze purchases at one point, not just on that stock, but a couple of the other ones that were experiencing high volatility, which created a whole you know, crazy amount of backlash and people talking about, oh, regulation versus deregulation, and you know, the hedge funders are saying this and that. And honestly, truly, it doesn't seem to be that we know exactly the details around it. I think I read that the guy from Robinhood, the CEO, has to go in front of a Senate hearing. But from my understanding, you know, Robinhood's still kind of like a new company. So just them, for example, when you have a huge volume and a lot of volatility of stock trading, right, in their business, there's something called the clearinghouse. So think of it as the regulators, and they have to send money essentially to the clearinghouse. So let's say you went from having, you know, $1 billion of volume to $10 billion of volume. You have to put more money into this, you know, regulator or this clearinghouse to be able to continue your operations. So apparently Robinhood, and maybe it was the same for other firms, were asked to do this. They couldn't do it, so they had to take their actions. But it's been honestly like probably more media coverage on GameStop than they've had the last decade, other than like, you know, this company is is going down the drain because their profits are not good and they've been closing stores and stuff. And I mean, with the share price coming down, I guess we're going to see, does it all come back down to the levels it was before? Yeah. But you know, then at the same time, so I just explained all that, but then, you know, last night I'm reading and I'm looking at something and I'm finding some article by this, you know, financial wizard type character, and he's saying, no, there was no short squeeze. You know, these Wall Street firms, they had already admitted that, you know, some of them were out of their positions already, and it's just the retail market going crazy. So this is the other theory that, and this kind of brings me to another point that you started with earlier on when you started the broadcast. People are looking for opportunities right now. You know, everybody has, for the most part, more time on their hands. You know, what month are we in like lockdown measures now? 900? I don't know. Like, we've gone through like a year plus or whatever it is of like, we have to do this, we have to do that. So, you know, a lot of people are looking at what they can do with their money. And it seems that, you know, no matter what, that is a big part of it, because it's retail investors that got involved and pumped the share price of GameStop, for instance, you know, or some of the other companies like AMC. You know, AMC Cinemas, like, is there a sector that's been hit harder? I mean, hotels, travel, stuff like that. But I mean, I'd say cinemas have been hit pretty hard too. And it's not like their business model was, you know, taking off before. I think they were losing ground to streaming and digital options. You know, one day their share price goes up 50, 100% and all this stuff, you know. So all of these things, you know, the way I see it, and I guess a message that I, you know, take from myself or would pass to anybody else, is take it as a message to be careful, because when speculation increases drastically in markets, it is often a sign that things are getting a little bit too highly valued. You know, when you're looking at fundamentals of any business, whether you're buying a business to work in, whether you're investing in a company, things like their earnings per share, their price to earnings ratio, their debt ratio, all of these different metrics, you know, help people value companies and figure out, okay, is it worth for me to invest in this? You know, like if tomorrow I was deciding to change careers and gonna go buy into a transport company, and that transport company has $1 million of debt and $500,000 a year of revenue and all these other liabilities, Now I might be getting myself into a little bit of hot water. I better have the financial resources to take care of those potential issues. And the same thing applies when you're investing in a stock, because you're buying ownership of that company. And if that company does go bankrupt, you are not going to get your value back. You know, if that company goes to zero value and they've got all this debt and stuff, the common shareholders are not protected, you know. And I think this is something that a lot of people often might take for granted, you know. So when markets get to this like crazy speculative level, to see a stock like GameStop that was like literally $2 or $4, like not even that long ago. I remember actually looking at it because in March to about May of 2020, you know, we had the first series of lockdowns. And I mean, I spent a lot of time on the phone talking with my clients, you know, the type of stuff that I do, and on the phone with institutions, and just and spending a lot more time, you know, stationary, whereas before I would have been more mobile, going to see people and stuff. And I was like myself looking on my brokerage account and looking at different shares. And I remember actually seeing GameStop at the time and seeing that it had gone from like $15 or $20 all the way down to a couple bucks a share, and being like, oh wow, you know, this looks like it's like could bounce back a little bit. But you know what? Their like business model is not looking great. Like, who's buying their games in a brick and mortar store these days? I'm not a gamer. I used to play games when I was younger, but I do know that games are primarily digital now, right? Like, if you get the newest Xbox, you can just download your stuff directly from Microsoft, right? In a lot of cases. So
personally for me, the way that I was doing it is I had because the new systems came out, right? So I was kind of watching a couple of stocks to look at. And like, I don't know if you know anything about the gaming industry, but because of COVID and all these things that have been happening, the consoles have been really hard to get here. So okay. There's been a huge like problem of getting supply to the actual consumer, where it's, you know, it's causing all these crazy things to happen. People are fighting over these consoles. So I was like, okay, well, considering they're one of the major retailers, you know, of selling physical consoles across North America, I was like, maybe it's a good time to, you know, get into it, because they're going to control a large part of the market. A lot of people are going to go to them to buy the consoles. So yeah, I did the same thing. I looked at their pricing, and, you know, I think at the time when I saw them, they were like $5-6 a share or something like that. I was like, okay, you know, it's possible. It's good. You know, like, I'll look in. And to be honest, I just kind of forgot about it. I just went on my day. And then when this whole thing came up about, you know, with the Wall Street bets and all this stuff and about all these guys investing, I was like, oh, shoot. At first I thought like, oh, everyone had the same idea I had. They're waiting, you know, like they're going to hit the stock while the console boom is going up. And then when the supply catches up with the demand, everyone will dump it so that way it goes back down. But then I started reading on Wall Street bets and all these other, like, you know, Bloomberg and all these other analysts for the market, and they start talking about like, no, this is a movement of, you know, people getting tired of hedge funds controlling the market, and, you know, billionaires controlling the way that funds are, you know, distributed, and who succeeds and who fails. And this is like a counter market culture, you know, movement of getting the normal person into this kind of endeavor. So yeah, it's just it's crazy, you know, that I guess I feel like this wouldn't have happened if it wasn't for COVID. I feel it, you know what I mean?
I say it, I mean, it's definitely related. And whether it's COVID directly or the bunch of factors that surround COVID, like, for example, stimulus money. You know, not that long ago, everybody in America, or almost everybody in America, got a $600 stimulus check, right? So that's a big part of the theory as to why markets have been going up, because as you're, you know, everybody gets a $600 stimulus check. What is it? It was like over $1 trillion. I can't remember the number, but, you know, in terms of like this round of stimulus, they released something like $1 trillion. 1.6 maybe is the number I remember. Don't quote me on that, and don't fact check me, anybody. But I think that's for sure part of it. I mean, but coming back to the markets in general, and again, I'm not an expert. I've been in financial services for about a decade. So, I mean, I've seen a couple different cycles, but it's not new. You know, it's not new that you see speculation, because I would say there's a difference between investing and speculating, right?
Right.
When you're getting involved in GameStop, like if you got in at $3 and you sell at $300, hats off to you. You know what I mean? Like that means you speculated and you made some money on it. But on the flip side of that, there's going to be a lot of people who lose money on that, right? And it's often the retail investor. It's often the person who does not know a lot about finance, and they see it going up. Oh, it's $250. Oh, it's $300. I need to get in. It's that FOMO they call it today, right? Fear of missing out, FOMO effect, and that's very real with investing. Like if you were to look at maybe like a long-term market graph, and you see like all the volatility, right? You always get to this point of kind of elation in the market where the values are going up and the values are going up, or, you know, people are wanting to not miss out. They get this fear of missing out. So people are investing, and generally when you use emotion to drive your investment decisions, more often than not, it might not end up with the desired result, because when you have that fear of missing out and you're seeing, like if you're already hearing about it and it's already everywhere, it's probably too late. You know what I mean? Like at that point where it's saturated the media, that's like that saturation point. It's like, you know what? Probably not the best idea to buy GameStop at $400 a share when their earnings per share are minus $4 or whatever it is, right? Their metrics, because they're losing money. And I don't think they were anticipated to turn a profit in any scenario until like 2023. So my point is that there is a difference between investing and speculating, right? When I'm getting involved in something like this, I have to equate it more to gambling, because if you're going to buy something, you know, at some crazy valuation, hoping that it's going to make money. I mean, probably some of these Wall Street bets guys, it was kind of investor activism. Like it seems like a lot of them were very directly concerned with going after the hedge funds, you know. And I mean, look, it's been not like it's a new phenomenon. Hedge funds have been shorting companies like since they've existed. This is what a hedge fund is. A hedge fund is really just like a group of kind of different investment strategies, right? Like a hedge fund is usually going to have 10 or 20 different strategies under that umbrella. It's not like one, I don't know how you say, it's not like one big juggernaut. Usually they have a bunch of stuff going on. And a lot of times they'll have short and long positions in the same stock to cover themselves. I mean, these people are professionals at making money in the market. So there's a lot of people out there too that are kind of saying, well, all these retail guys, you know, they're going up against, it's all nice and fine, but we're going to see what happens. And I mean, I guess, unfortunately, when you look at a minus 50%, unless GameStop jumps up 100% again tomorrow, it seems like they were kind of right, you know, like a lot of these retail investors and a lot of these Wall Street bets people or whatever they came from, they kind of joined the ride. But at the end of the day, who's going to keep their money in when everybody kind of knows that the stock, I mean, could GameStop end up finishing off after this whole kind of, you know, return to normal at a higher value with a bit more market capitalization than they had before? They could, but it's really, I think it's really more than anything to me, an example of how the markets are very liquidity driven. You know, like there's a lot of money that people had to invest into stocks because as we said, the stimulus, and maybe, I mean, also the fact that a lot of disposable income, I think in Canada, I'm not sure in the States, I think in the US too, savings rates, you know, for the first time in a number of years increased over the last 12 months or so. People aren't traveling, people, you know, aren't going and taking vacations, they're not spending as much money, things are closed. So you have a bit more disposable income too. And to your point earlier, a lot of people are investing that in the market.
Yeah, and it's pretty crazy because you're watching this whole thing transpire. And like you said, people aren't doing very much with their money. They're not, you know, everyone's kind of afraid of, I don't want to say people are afraid of tomorrow, but because of the volatility of, you know, is the market going to open back up again? Are we going to be able to go back to work? People are very skittish about spending a lot of their money. And I think in a position where I don't want to say that investing has been something for kind of people who are in a preferential financial position, meaning that they could play with their money a little bit more. But I think now, because of the way that everything is and the limited amount of opportunities there is to grow your money, I think the stock market has just become that much more enticing to people, and it's now driven this whole. It's driven. I feel like what it's really done and what we're seeing is a new generation of guys who are probably younger than us, like people who are in their early 20s to mid 20s now, who are, instead of worrying about showing off and buying new cars and doing all this kind of things, they're like, well, we can't really do any of those things right now, so let's what can I do with the limited amount of funds I have? Well, I can fuck around in the stock market and see if maybe I can make some extra cash that way, or I can invest it here. And Reddit's like not the cool kid thing, but Reddit's like a group of like-minded youngsters who are going to, I guess I want to say, they want to like establish their position. They can't do it in the job market right now because everything's shut down. They're trying to take over somewhere else.
I mean, for sure, I think that there's a lot of different issues that kind of come together when we're talking about this, right? One of them, or issues, questions, factors, however you want to say it. One would be the search for yield, to kind of build on your point, especially young people. I mean, and this goes for baby boomers and anybody else too. The other impact of this, fiscal policy. So the stimulus is one part of fiscal policy, right? Because in Canada we had the CERB, right? Canadian Emergency Response Benefit. They have wage subsidy programs, business owner loans. So these are all kind of like stimulus type programs. Then at the same time, with monetary policy, there's also the central bank's role in controlling the flow of money. So that relates to what they call an overnight rate. So I don't know if you ever heard like the bank rate or the overnight rate, what it's set at, at 0.25% or 0.5% or whatever.
No, what is that?
So how it works is that the central lender, the central bank, so the Bank of Canada here, the Federal Reserve in the States, they are the ones who are tasked with creating currency and controlling the flow of currency, if we want to simplify it a little bit, right? So how it works is that they're charging a base rate, right? So let's say 0.5%. I think in the States it's 0.25. Again, don't fact check me. It's like 0.25. And I think in Canada we're like, it's close. We're always very close to the US. So what it means is that they call it an overnight rate because this is essentially the rate that they are giving to other financial institutions. So if we use Canada, for example, you've got the central bank, the Bank of Canada, and then you've got like RBC, BMO, Scotiabank, right? All these other lending institutions. So what that overnight rate means is that it's an interest rate that those banks will get for keeping their money with the federal bank, for instance, like the Bank of Canada. So it's very low, right? Whereas let's say maybe 20 years ago, it was 2% or 3%. So they would be able to generate interest from, let's say, holding funds. So at a time like now, and pretty much since 2008, when the last financial crisis was here and interest rates really dropped, for the first time, in a while, to a very low level, excuse me. Basically, it's stimulating lenders to put money out there, right? And you're not going to make money by holding it. So what you need to do is lend it out. So that creates a situation where yield, so yield would be more referring to interest rates, like what can I get if I buy a bond today? Like I always remember this. My uncle was a very savvy investor and he taught me a couple of good lessons when I was 16, 17, 18 years old. But I always remember these days because I remember him showing me like, part of his portfolio and he's like, yeah, I always keep something in bonds. And I think at the time he was getting like 5 or 6% on a bond, which is 5 or 6%. That's a fairly reasonable rate of return. Today, that same bond is going to give you 1%. Bonds today, you're looking at 0.5% or lower for something very short term. And even if you're going to like a 5-year bond or anything like that, you're maybe you can get 2% in some kind of promotional deal, but really it's like 1 to 2%, if that. So that's a very low yield, right? And then if you factor in inflation, okay, well, I'm actually losing money because if inflation is 2% or 2.5% year over year, and I'm getting 1% or 2% on my investment, my real purchasing power is decreasing, right? So going back to this overnight rate, so the central bank or the Bank of Canada, if we're staying with the Canadian example, is, you know, essentially wanting the other banks to lend out money to stimulate the economy, because if they're lending money, then people are able to spend money. And on top of that, in the US, they've been doing it a lot more, but in Canada, they did do this in, I guess, March to May. I'm not sure if the Bank of Canada is still doing it, but they started purchasing bonds. So let's say, I'll take the US example, because this is something I've heard spoken about many, many times. If the US Treasury is releasing, you know, these bonds for people to buy, the Federal Reserve is buying them up, basically, or buying up a large quantity of them, which essentially keeps the price low, right? So what that means is that interest rates are held low, which people can't make money on interest rates. You get 1% return. Well, we all know, we just went into that. It's not very much. So what does that do? Makes people find other options to make money, right? So there's multiple different factors, I think, that are leading to why markets have gone up the way they are. There's the direct stimulus, and then there's the monetary policy. So they need people to invest their money. They need people to be producing in the economy. And it's just a matter of everybody's kind of looking at the same, solution. We've seen the housing market here in Canada like really explode as well. I don't know if you've been paying attention to home prices, but
once you buy one, it's like your whole world changes, because all you're doing is looking at, you know, what's the equity of my home? How much money, like, you know, what's the prices of houses going up next to me? Can I move into another home? You know, it's like once you buy that first one, or you invest in property, it's like it just becomes part of your life. Like you want to know what, like, you know, what's your investment returning to you? How much power do you have as far as, I mean, even with us, I think, what was it? We just re-upped our mortgage, and we were looking at it, and we couldn't believe how much money they were like, yeah, sure. Yeah. It's worth this now. We're like, what? No. You're ridiculous. What are you talking about? And then we started looking around, and we're like, why? How did this happen? Like, how did this work? And then even with what's going on now, we were kind of expecting to see housing prices go down, because obviously, you know, everybody's ability to spend at this point has been, I would say, greatly affected. But you still see that the housing prices in Montreal, especially, are still going up.
I've seen clients who look like they had a $200,000 gain in equity in the last year and a half, because when we met a couple of years before and we're going over everything versus, you know, the conversation we had in the last 6 months, and people selling their houses in like a day, you know, and all this stuff with the market. And you know, prices of real estate have gone up a lot. And I guess maybe the point I was alluding to, for millennials, you know, a lot of people are getting priced out of the market. So again, the reason why people are looking at places to find returns, right? And when you see the stock market, oh, hey, you know, Tesla went up 10x in 2020. Let's get in there, or this company or that company. And people are really, I think, hungry to try to level the playing field, as you said before. And I mean, that's a very common theme out there, wherein a lot of people are trying to find a way to grow their assets, and some of them it's directly to buy a home or whatever. Risky strategy. I mean, at the end of the day, like I said, there's a difference between investing and speculating and trading and all these different things. And when you have asset prices increasing drastically, for sure it's going to impact the thoughts of the younger generation. I mean, there's a lot of literature out there that the millennials, which I guess we're kind of on like the high end.
We're at the beginning. We just make it into the millennial.
Let's say the younger millennials, you know, people who are in their late 20s right now, or mid to late 20s. It's a tough, I'd say it's a tough start, when you're looking at trying to get your career going and, maybe start a family or get a property and all this stuff. I think even just looking 10 years ago to now, I feel like it's a pretty big difference,
Yeah. Well, I mean, I was talking to my mom about a month ago, just before Christmas time. And we were just discussing, we were just talking about, she was telling me about when she was growing up, and my mother at 18 moved out of the house, got a full-time job, bought a car, and then 2 years later bought her first apartment. And I was like, at 18 years old. And I'm like, yeah, I would say it's plausible you could do it now, but it'd be very hard to equate that much equity in yourself and have that much buying power at 18, 19, 20 years old, aside from being a professional athlete or something like that, but just being, a general person out of design school and just going in and, going and say, yeah, I got a job. Okay, I got this job. I go to a bank, I get a loan, I get for my apartment, I go buy a car, I'm ready to go. And, boom, I'm off and running. And then we just got to talking about it, and I'm like, listen, you look at, how long it took me into my mid-20s to where I could start to afford a life. And now even you look at the millennials, and I'm just like, it just seems that ability that the boomers had, where they could at 18 just jump up and get their life going and move out and start conquering the world. It just seems like that gap just starts getting bigger and bigger and bigger and bigger, to where it's I feel like it's almost like people are almost in their close to their 30s before they're actually in an opportunity where they can actually, start thinking about, I want to buy a home, I want to have a car, I want to do this, you know what I mean? And I'm just wondering, as far as a market wide, I guess, I don't know if you could really answer that question or not, but is this a good thing to have that gap keep growing? Or is this something that we need to really kind of look at and figure out, how can we get these people into positions to where they can start contributing to the market and to, into the economy, and earn real money, as opposed to living off their parents' or borrowing their parents' car? Because I feel like for the market wise and economy wise, if someone can get up at 18, 19, 20 years old, decide, hey, you know what, university is not for me, I'm going to go to a trade school or something, I want to get my life going, I feel like that's better. But I feel like the market and economics in a whole is kind of playing against that to a certain extent.
I'll say it again. I am not an expert in financial markets or economics, but I don't think you need to be an expert to say that, no, it's not a good thing. I mean, if I'm not mistaken, and again, I won't quote percentages or numbers, but I think in the last year, there has been a record number of millennials that have returned to home to live with their parents, whether it's because they lost their job, whether it's because, they're just trying to, decrease their expenses, whatever it is. Maybe they're trying to save money. I mean, I've spoken to people specifically. It's like, well, we're living at home because we're trying to save money to buy a place, and I can't go and rent and spend money on rent, because rent's pretty high too in a lot of places. Sometimes I have younger clients telling me how much they're paying in rent, and I'm blown away. I'm like, really? With interest rates, because the other factor is that interest rates are low, so that would usually equal lower mortgage payments, right? Because if my interest rate is 4% versus whatever it is today, 1.7%, you can get a 5-year fixed term mortgage these days. Sometimes even it's less money on a monthly basis to buy versus what some of the rental prices are. But you still need the down payment, you still need to qualify, and all these other things. And that's where sometimes it gets a bit tricky, because maybe my payment's going to be less, but maybe my credit score is not good enough, or maybe I don't have enough of a down payment, or maybe my ratios aren't good enough because I have too much other debt and I can't fit into the ratios, because those are more tight than they were before. So to go back to the first thing you were saying, I don't think it's a good thing. I mean, my personal experience, I've got 3 young kids, and I have essentially really worked nonstop for many years. And I feel like, if I look at my grocery bill, or if I look at some of the different expenses that you pay on a regular basis, they've gone up. They've gone up over the last 5 to 7 years, and that's the real impact of inflation. Whereas your mom, I'm not sure how old your mom is, but let's say she's in the same age.
73.
She's a little bit older than my folks, but I mean, pretty close, right? I mean,
Yeah.
let's say she was buying that first home. She was probably looking at a bungalow that she could buy in some suburb in Montreal for like 50 grand, like $50,000.
In Dorval.
It was
She's looking at a
$50,000.
bungalow. Yeah, it was nothing. My parents bought the house we lived in for $37,000.
There you go.
And I remember when I came back. So the year that I came back, and I came and played at Concordia with you, I remember I went out running that day, just to get back into things. Came home and the phone called, and it was It was like a mortgage specialist, or it was like I guess a local real estate agent or something. And he's like, Mr. Butler, and I was like, yeah. He's like, are you by any chance selling your home? I'm like, oh, you're looking for the wrong Mr. Butler, because that is not me. He's like, oh, well, do you know if your parents are selling their house? I'm like, I don't think so. They're like, okay, because I think we can get somewhere around the range of $650,000 for your house. And I was like, huh? I was like, are you sure? I'm like, and my parents live in a very again, they bought their house during that whole Duplessis era thing where they were saying we're kicking people out and we're going to kill people and all this kind of stuff. So a lot of people bailed and went to Ontario at that time. So that was a very unique period in history in Montreal. But like my parents have an acre of land in Point Claire.
Wow. That's rare, right?
Yeah, which is, they got this weird house that just like the people who lived there before were just, it's a very unique property in itself. And in the area where they live, there's actually a couple of those places where you would never think that there's so much there. But then when you actually go, you're like, whoa, this is huge. Like, the house is old. It needs to be renovated and stuff. But it's just, yeah. But I mean, even us, like when we were looking to go back to the point that you were making, when we decided to go buy something, it was because we got to the point to where when we were renting and we started looking at our bills every month, we were like, why are we spending this much money on rent when we could just go and try to buy something? Because at least if we're spending money on a mortgage, we're furthering our equity, we're bettering our credit, like we're looking like responsible, financially responsible. Whereas spending money on rent doesn't do anything for anybody. Like you don't get any kind of benefit. So yeah, just when you said that just reminded me of that conversation we had, like when we're like, well, let's stop renting and let's just go try to see if we can buy something. And then, yeah, we went through the whole process. How much can we get? What are we doing? I think at the first one, like we had to get our parents to just co-sign just to make sure that and that's another thing too. My mother just went out to the bank one day and said, hey, I want to go buy this and this, and this is where I work. And they said, cool, go. Now it's like, how much money do you make? How much money does your partner make? Do your parents want to co-sign with you? Do this? Do you have any equity? Do you have any of this? Do you have that? And it's like, I feel like, especially with the market collapses that have happened in the last, 10 years? I know banks are super controlling the cash, but like
mortgage underwriting has changed a lot. Yeah.
Yeah. So I just feel bad, man, because it's like you got to have so much cash up front, or you got to have someone co-sign with you to even get like acknowledged of the thought to buy a home anymore.
I mean, it's becoming, a real tough proposition for a lot of young families, because there's also the stability aspect, when you're renting. I mean, hey, some people find a great place to rent and they can rent for long term. Let's say you got a 1-year-old, a 3-year-old, or whatever combination of young children. You don't want to be looking at the prospect of moving year over year either, right? So owning your home also presents a certain amount of stability. This is why people do it in a way, right? There's the value part, but there's also like, this is my home. This is where I live. I know I can stay here. And for sure, yeah, mortgage underwriting, I mean, just in the last couple years has changed a lot. But for sure, from the time when your mom was going or my parents were going, the rules, they are stricter. And some of that is good, some of it is bad. It's really hard, right? Regulations always have two sides to them. But when you look at what happened in the States in around 2007 to 2009 with the subprime mortgage crisis, that financial crisis was largely set off by these risky loans and just like a market that went completely bananas. in Canada, one thing you can say with the regulations is being a little bit more regulated and in general having a more conservative approach. You never know, but it seems like they're more careful in terms of, who's getting that, who are getting those loans and what are the qualification criteria.
Yeah.
I saw, I always remember this because and it's like off color a little bit, but it was like a little bio piece about the whole subprime crisis in the States. And they were going into the details about how one Miami stripper owned 5 properties.
Yeah, I saw that too.
They were able to leverage, but it was fraud, right? The brokers or whoever was involved were just like, oh, we're just going to keep pumping these out because we just want to keep making money.
Of course.
That just would not happen here, based on the way the regulations are. So the CMHC, which is the Canada Mortgage and Housing Commission, which is the main insurer for loans. So let's say if you're able to put more than 20% down on your property, let's talk about a principal residence, then you can kind of bypass that CMHC insurance. And how it works is you would have to pay an additional premium if you're under 20%, and it's prorated from 5 to 20. And basically what it does is that premium is going into the Mortgage and Housing Commission, right? And then those funds are theoretically held there in the event that there is some kind of financial crisis in housing, and then they can use those funds to try to stem that tide. So I think in the States it's called Fannie Mae and Freddie Mac. Again, I'm not an expert, but
Fannie Mae Foundation or something. Yeah, I think so.
And like they were going bankrupt or whatever. Anyway, this is like ancient history now, but it's a very hot topic though in terms of like the housing market in Canada and where it's going to go. A lot of people ask that though, like I've got a lot of young clients who are like, oh, we're trying to buy a condo. Should I buy now or should I do this and that? And God, it's so hard to say what's going to happen, right? I know realtors who I work with and they're all working. Their business is it's in a rough spot now too, because they're all adapting to the new, let's go virtual tours, or now I guess with the curfews, it seems like everybody's got to go visit places on weekends, so like weekends are completely nuts. But our price is going to come down. Our prices in certain segments going to come down. I think most of what I've read or understood is that no matter what happens, it's going to be regional. Like you'll see maybe different pockets, different regions. But for sure, experienced the greatest increase in demand are the suburbs. Whether that's the West Island, the South Shore, like there's parts of the South Shore. St. Lazare. Yeah, this is my area.
Funny thing, so our old neighbors were moving, or they decided when COVID happened, because I think they had the same freak out that everybody had. They decided they're like, we don't want to live in the city anymore. Too many people, too much chances of getting COVID. We're gone, So then they were part of that mass exodus that got out of the city as soon as they could. But they were telling us while they were trying to, find a place and all this kind of stuff, they're like, it's the first time in history that there were bidding wars for houses in St. Lazare. Yeah. He's like, there was literal bidding wars. He's like, usually, especially in Montreal, what happens is somebody puts up a price, there's a negotiation, back, forth, whatever. Usually the owner comes down a bit, you come up a bit, you meet in the middle. He's like, it wasn't like this. He's like, literally the owner posted the price, and then it was just like, you just waited to get that phone call. Like, it wasn't enough money. Somebody outbid us. We got to, do you want to go higher, or do you want to, I was like, is it really worth it now to buy that?
I'll take credit for living in St. Lazare before it was cool,
Yeah, that's it. Oh, that's it, right? I feel the same way living in Verdun.
It's so funny though.
Verdun years before it got like super expensive.
I've been out in this is like the Vaudreuil-Soulanges region. Yeah. So, Vaudreuil, St. Lazare, Hudson, Rigaud, like the first house I was living in was in Rigaud, actually, a small bungalow. Right. And I've been in the region, I've moved a couple times in the region, but St. Lazare, and it's so crazy because what you just said is like a very new phenomenon, because 2, 3, 4 years ago was the complete opposite. You could have your house on the market for a year in St. Lazare and you're not going to get an offer, maybe I'm exaggerating a little bit, but
it was about that. It was
go
about
from
that.
that. And I remember speaking to clients in the summer. One guy I remember specifically was like, I've tried 3 houses and I've lost 3 times trying to find a property out here. And that's it, right? There was a big push of people just kind of trying to de-urbanize. I don't know if I just made up a word, maybe, but
Coin it, de-urbanize. Will Miller.
De-urbanize. We're putting it in the dictionary.
That's it. It's in the Urban Dictionary now. I love it. It's perfect. But
Tons of stuff going on these days, man.
Oh, it's crazy. But yeah, I mean, even here in Verdun, man, it's like we bought our place for like
Very
pretty
popular.
Yeah, we bought, because even I remember when we were looking, we were looking for a spot, and I remember I was looking around because at the time everybody wanted to live in NDG. Westmount was still super expensive. You could live downtown. We didn't want to move to the suburbs because that's the time when like the West Island was getting expensive. Like that's when the West Island prices were starting to really go up because everybody our generation who grew up in West Island, whatever, were moving back. They were getting out of the city and going back, so the prices were shooting up. And I remember sitting there thinking, like, okay, well, what's close to the city but not the city? I was like, okay, well, LaSalle, Lachine, and then Verdun's that weird little pocket town that's like, you know, not far out as LaSalle, but not close enough as the city. And I was like, let's go check there. Luckily, we found the place we live in now, but now it's like, we try to find places, it's like everything just
very
like
popular. I've heard a lot because it's gentrification, right? Verdun's gone through a lot in the last little bit, and there's a lot more families and stuff moving in. It's kind of been, you know, working on getting it to be a more community friendly place. Because I mean, from when I was a kid, right, or when you were a kid, Verdun had this like stigma to it. I don't know.
No, Verdun was a ghetto. Verdun is still Verdun. You still got the crackheads every once in a while that, you know, come out of the woodwork, you know. But now you got like one crackhead at night, and then you got the family of 4 who's walking to the ice cream shop to go get their food. You know, it's like you can see the balance is forever changing. You know what I mean? But it's like it's interesting to be a part of the gentrification, and it's interesting to see it happen. The only thing that really kind of, I don't want to say it infuriates me, but it kind of saddens me to a bit is I don't mind gentrification. I want to call it like organic gentrification. Like, you know, when someone like you or me comes in, we see a place that's a tiny bit dilapidated or whatever. And we're like, you know what? I'm going to buy this place cheaper. I'm going to put some money into it. I'm going to make it nicer, you know, and then other people like me will come in and do the same thing. But now what I see is often these big corporations will come in, buy a lot of land, and put condos on that land. And to me, I see that as a detriment because what you're doing is now you're raising the price per square inch because they're going to charge a crap load. And it, like you were talking about before, it outprices everybody who's coming into that, you know, new home buyer area and forcing them to have to deal with, like, in a place where they may have gotten, be able to get like a bungalow, like you said, you know, to get like they got to get like a 3.5 or a 4.5.
Yeah, 600 square feet of living space or whatever it is, right?
That's it. And it's like I kind of wish that I know Montreal does put some limitations on these things to a certain extent, but I wish there was some kind of regulation as far as like, listen, like you got to have a certain amount of demand to get these things built from like people whom aren't businesses or people who own 6 or 7 different properties, so that you can kind of just sell them out and move them on. Because I feel like in the end, we're going to end up becoming like the UK, or New York, where it's like you're, instead of buying a home, you're buying a room.
I mean, I was listening to a podcast talking a lot about like the drivers to home constructions. And again, not an expert, but it seemed to be rational what they were saying, wherein, let's say the developers, as time's gone on, right? Like, whereas maybe before you could make money as a developer building whatever size project, today it's a little bit different. I don't know if it's to do with like the size of the project, or because there's a lot of expenses that go into it, right? Like they have to build, but then they have to pay the city and they have to pay this certificate and they have to do that. And there's like a lot of stuff that goes into it. So what they were trying to say is that like it's not just one factor, but there's like many factors that lead to this result where you get these like massive projects, right? Like you're saying, you know, the whatever it is, the 30 condo project that's coming up, whereas before it maybe wouldn't have had the same kind of same kind of feeling, and it kind of creates this different mentality or different lifestyle, right? Because I don't know. I mean, there's always going to be a demand for families to have space no matter what, but there's definitely on the island, and maybe it's also in Montreal because it is an island, right? There's limited space to build. But yeah, I agree. I mean, I don't know. I'm surprised that condo prices haven't come down, and I'm not an expert again, but I just feel like there's so many condos out there.
I just feel like, it's got to be a bubble somehow. Like there has to be some kind of artificial situation that's going on where it's causing these things to go up and stay up. Because I feel like, especially at this time where people have less money to move, they have less ability to move, they have, different things. Like, I feel like based on, like market forecasting and understanding money to a certain extent, like, I feel like that should have brought shit down a little bit to where people are like not wanting to live in the city anymore. So the prices should come down a little bit more. But it seems like they just stayed at the same or moved up a tiny bit.
It could still happen. I mean, a lot of the economists, their perspective on what's happened is that we still haven't felt the real economic hit yet.
Okay.
And it's kind of rational because when you think about it, right, since the pandemic hit, a lot of people were able to go on a relief program where they defer their mortgage payments, they defer their car loans, they defer this payment, they defer that payment. They're getting the CERB, they're getting income coming in, they're able to cover things. But when you have like a really big event like we did, and when you go from having, I don't know what our unemployment was, but I think it like almost doubled at one point and it was temporary. Unemployment was temporary because a lot of companies furloughed employees and stuff. But now we're also seeing more people who are like slowly being laid off. And I mean, I've seen it anecdotally, you read about it. So there is the possibility that we still see a little bit of this pain come in because at one point you can't keep deferring payments. And at one point, maybe that demand for, one segment, I personally don't think like bungalows, for instance, in the South Shore or in certain different areas are going to go down because I think there's like that segment is huge demand right now because there's a lot of people, if you look at like what housing looks like, right? Like you've got condos, then you've got like bungalows, single family dwellings, townhouses, like, right? You can have a family of 5, a family of 6, a family of 4, whatever, right? And then you've got like bigger type properties, where you have maybe a little bit more space. You've got a 2-car garage, you have an extra couple rooms, like, and maybe those properties are priced a little bit higher. At least, and maybe they have gone up, but I don't think that they've gone up at the same rate as like a bungalow. Like if you think of a bungalow in a South Shore, I have a lot of clients in the South Shore, so I have a couple like that are really close in my head where maybe that house was worth 250 or 300,000 literally 12 months ago, and now it's like 400, 450 in bidding wars because everybody's trying to pile in to find these properties, right? Because maybe they can't get approved for the $700,000 loan either. So anyway, there are certain segments that'll probably still have a high demand, but we don't know yet. I mean, how do we know what's going to happen in 6 to 12 months? We don't even know when we're going to be able to go out after 8 p.m. again, right? Like, so there's the possibility that we still see later on this year some of that kind of like trickle effects where maybe people, more people lose their jobs, or the job market doesn't rebound as fast as it did. The economy stays a little bit depressed. A lot of different things, man. All we can do is try to be responsible and not lose our minds. And
also, I think I'll make this last point and then I'll let you go. But also, I think about what happened is I think the psychology has changed because I think like we're seeing it here, we're seeing it in LA, we're seeing it in New York, but there was this this fluttering to an area. Because you believe that if you were just in the vicinity, you would somehow catch that, you catch the money falling out of the sky, to a certain extent. But I think now especially with businesses forcing change where we have to work from home. So now, where a lot of businesses pushed back against that and didn't want that to happen. I think a lot of them are embracing it now because they're seeing that, well, we don't have to pay for huge infrastructure. We don't have to pay for physical places to put people. We can just let people work from home and it saves us money. It saves them money. And we don't have to, and in doing that, I think it's had that ripple effect where people are like, oh, I don't have to live 16 blocks from the office building that I work at anymore. I can go live out in Repentigny. I can live in Vaudreuil or Chateauguay and be okay because I don't actually have to physically go there
every day, right? Yeah.
That's it. So yeah, but hey, listen, Will, I thank you so much for coming in and talking about all this stuff. I know very little, and it's great to talk to somebody who has a better understanding, and it's part of their livelihood. Anytime there ever is some kind of like financial thing going on, I'm definitely going to ask you to come back and we can talk about it because this was a lot of fun, buddy. I appreciate it.
Great talking. And I mean, I just want to come back to that first thing we talked about quickly before I go, Blake, because I mean, there's one thing that I had written down in my notepad that I was like, oh, going to be chatting with Blake, we're going to be talking finance. What's one thing that you could say to people or whatever it is, just, to take note of, the GameStop point that we started this conversation about, and this, speculation, our market's highly valued, where is the money coming in, all this stuff, right? And it's like really hard to know, it's really hard to know what's going to happen at any given time. So like, I just, people got to be careful. You see something like that going on, you want to take a risk, you want to gamble a little bit, do it with something that you can afford to lose it all. Don't take your house savings and go pump it into something like that, thinking that you're gonna become rich. And just try to take a deep breath and just make sure that you take all the factors into consideration before you make that kind of decision. And in general, the best way to put money into the market, whether it's going into a fund, a stock, whatever it is to dollar cost average. So that's like one thing, and go look it up after. And anybody who watches, I hope that they would be able to use that. Dollar cost averaging is when whatever you're buying, you're not buying it all at one time. So if I have $10,000 and I want to invest it, and I invested in GameStop, right, when it was $400, then it drops to $200. Now I've got $5,000. I don't have $10,000 anymore. Whereas, and that high risk example, but if I took that $10,000 and just split it into 4 purchase times, right? So instead of investing all 10,000 at once, I invest 2,500 over 4 times. I'm going to spread my risk out, right? So it doesn't apply to GameStop because I wouldn't have done it either way. But the reality is, no, I mean, look, you want to take a bet on something, right? But again, be prepared to lose all of that money if it did go wrong. But in general, if you're saving, split those investments up. Don't drop one big lump sum, again, unless it's that specific idea and you just have to do it. Make sure that you do this over a strategic period. Spread out your purchases, because now you're going to buy at 4, 5, 6 different prices. Again, it can be a fund, it can be invested into anything. And that way you're going to spread your risk out, and you're not going to be like giving yourself the opportunity to lose so much in one swoop. So I just wanted to come circle, because that's like literally the one, it's DCA I had written in my notebook. I was like, if you say one thing to people, talk about dollar cost averaging.
Oh, and that's a good point. I think especially with the way that everyone and the group of people who are really getting into this market now, I think having that idea that you need to be conscientious of what you're doing, and that think about it as like, the way I was explained to it is, think about it as if that money that you were going to go buy a pair of shoes with, that money that you were going to go to dinner with. It's like, think about that, take those purchases for a month that, would be excess. That money is the money that you can go and play with. He's like, all the other money that you need to leave, that is not, you can't touch that. He's like, whatever you're going to play with, that's the money you can go invest in, because if you lose it, oh, well, you lost it. But if you gain on it, well, you can go buy the stuff anyways, and you got a little bit more money in your pocket.
There was a study done in like the financial planning type world, and they talked to a bunch of millionaires, right? Or millionaires, people who had accumulated $1 million in total assets, right? That could be from a lot of things, but 70% plus of their success was attributed to discipline. Discipline, saving, sticking to a plan. I'm putting away X here and Y there. This is what I'm doing over and over and over again. And when you just keep doing it, this is where you find success. So over 70%, not the asset quality, not making a huge return, not getting rid, none of those things. 70% plus was just from the discipline of doing it over and over again. And no matter what, not wavering from that plan. So I think that's a huge thing for people. And I think that's I mean, younger people have to. I mean, our generation and anybody younger than us, they have to be very disciplined because, it's a risky climate out there for sure.
We're going into a very volatile time with the way that everything's changing. So yeah, you gotta be able to stand, against the waves, because if you ride them, there's a good chance you're gonna get washed out into the ocean. Yeah. All right, Will. So, real quick, where can people find you? Where can they get in contact with you if they want that financial advice, or you know what I mean? They want to they want to talk to you about some good stuff. Where can they find you at?
If you want to reach out to me, you can reach me on my email, millerfinancialgroup@outlook.com. You can send me a text message on my cell phone, 514-502-3440. Plenty of people have my number. All my clients have my number. I'm pretty active on social media through LinkedIn, Facebook, and on Instagram. My handle's Downtown Bill, throwback to the old days. But yeah, definitely millerfinancialgroup.com.
There you go, Downtown Bill.
Yeah, reach out and touch base, 514-502-3440. Send me a text message, give me a call, anything. I love talking to people. So it's even if it's just to chat a little bit, even if it's somebody who I haven't seen for a while, we just want to talk, man, give me a call.
For sure, 100%. All right, Will, appreciate you so much. Thanks for coming out. Thanks for listening, people. Appreciate it. Thank you. Out.